Welcome to our new program, 401k Real Chat. This is Fred Barstein, contributing editor for wealthmanagement.com's RPA Edge and CEO at Trow, TPSU, and 401k TV. I invite the most interesting, innovative, and impactful retirement and wealth management professionals that I know, asking them to provide open, honest, and candid answers to three important and at times difficult questions. So let's get real. So this episode, we host Dick Darian and Peter Campagna from the Wise Rhino Group, the leading M&A RPA advisory firm. Dick is the founder and CEO, and Peter is the managing partner. So welcome, Rhinos.
Thanks. Fred. Good to be here, Fred.
Thank you.
And I guess the interesting people couldn't make it, but we're glad to fill in.
Yeah, well, second and third tier sometimes do well, so that's what we're hoping for this call.
You know as well.
So, Dick, when did you have the idea for the Wise Rhino Group? I know you were at BlackRock and making a pretty good living and doing well there. Yeah. And what did you see happening and changing that was going to take that kind of risk where, okay, I'm going to jump off now and do something on my own, right?
Yeah. No, well, Fred, it's interesting, like everything, the past informs the future, right? So, look back to the National Retirement Partner days. That was 5 years there with Bill Chetney and Bob Francis and Tim O'Brien. And, boy, what a great training ground for understanding that particular part of the business. It was a little early, but I'd say that experience combined with BlackRock being a heck of a perch. Peter and I worked there for, 8 years, and every part of the retirement business was touched there. There were tremendous people, smart people, and you really had a great perch to see the whole business. And then, my style, which wasn't always in sync at BlackRock, was to be on the ground, doing things with FlexPath and building that business with Vince and, all the other things. So, number one is, I always dove into it. I really felt I was a student of the game. I understood it from the ground level. I've always been a fan. Peter knows this. Peter, when you and I started working together, I was drawing charts, talking about where it's going and all that stuff. And so, Fred, I would say that's number one. Number two is the curiosity, right? You know me, I've always been curious. And, that I think is the thing that leads to then, where's it going? What are the different paths it could take? So all those came together. And then, Fred, you were the first one to talk to me about the consolidation curve, and the Harvard Business Study, Kearney and Company. And all that made sense to me. And as I began to really look at what the record keepers were going through, and it was very clear consolidation was changing that industry, BDs, very much in the institutional investment business with Mercer and et cetera. And then understanding what was going on the wealth side, which had a much earlier start, Fred, than retirement to the consolidation, and lastly, insurance brokerage. It was very clear that it was inevitable that the retirement advisory space was going to consolidate. Like that was something you and I talked about quite often.
And why do you think it happened at that point? Because it took you a couple of years, right, to get traction. And I know, you knew the aggregators. You helped me build the aggregator roundtable and everything. But it didn't happen like just you opened the doors and the business flooded in.
No, Fred, part of that is, the word serendipity. You kind of 40 years, you take 10 shots. One of them goes exactly right. And I would say this one did. And I think it was a combination of kind of knowing that we were close, it was going to happen. And I think it was a combination of looking at the different, you talk about the Goldilocks zone, and you had to have money flying in. You had to have advisors hitting the right age. You had to have buyers emerging, Fred. Like many of these firms, it took 20 years after they left the wirehouse. Vince Morris, Fielding Miller, Interstate Johnson Lane. These guys had to go out, build a business, get big enough so they could begin to buy, and other firms had to get big enough. So all that came together into a mix of an alchemy that made it all happen. Part of that was that I could see. The rest of it, Fred, is just, maybe dumb luck. But I would also say that to some extent, Peter and I also facilitated the market. So, people joke with me and say, boy, did you get there when it was happening or did you create it? And I'd say there's a little bit of both. I think we made it easier for it to happen. And coming in, Fred, I felt two things. And I looked at it and said, wow, this is going to happen. And, probably the most comfortable thing I ever kind of felt or talked about, which was, I think I'm the guy to help do this. I've been in the business for 35 years. I've always tried to do the right thing. People trust me. I know a lot about the business. And then Fred, lastly, there's a ton of empathy there. I love these guys. A lot of the people that Peter and I have worked with have been friends of ours for 30 years. So right. that component and everything else kind of came together.
Fred, the personal side of it is we have, like Dick said, people who we've known and really liked and worked with for years being approached directly, right? And saying, hey, we have a big check for you. Hey, we have all these opportunities for you. And them turning around and asking us, saying, what do we do? Is this a good fit for me? And you start to think in your head, wow, these folks need a guide. They need someone who understands the buyers, the sellers, and what it means. And that's organically just being asked what we thought about our friends being approached. We say, well, these guys need some representation, right?
Yeah, I always, it's hard. Sometimes it's hard to have advisors hire advisors, right? It's their business, but they don't want to do it. So what's the current state of the retirement plan advisor M&A market? Who are the buyers and what are they looking for? And who are the sellers right now? And are you seeing any bit of buyers or sellers remorse after 5 years of pretty heavy activity?
Yeah, let me start out that one. I'll say that the current state of the M&A world is changing. It's evolving, but it's actually still, I think, really, really strong. And it's strong to me because the thesis is still very valid, right? And there's all kinds of, there's wealth aggregators, retirement, there's insurance brokerage. But when you think about this idea of insurance clients being approached to do retirement plans, and then when you have the retirement plan being approached to do, these folks approached to do wealth and financial planning, the more ropes you throw over, the harder it is for you ever to leave that organization and the more valuable and intertwined you become. So when you look at historically what's happened the last 5 years with this huge tailwind of money basically being free, right? Driving a lot of this. But when you think about what's happened the last 2 years, 550 basis point increase in cost of capital, literally that tailwind turning right around to being a stiff headwind, and things are still very strong, that is proof that that the thesis is valid and that it continues. It might change and evolve, but this M&A market stays active because it makes sense.
Well, and there's also, Fred, there's also, succession. Advisors have a business, they're getting older. The numbers that they're getting paid externally are so high still that internal succession is hard. It's hard for junior partners to pay anywhere near a price that a buyer in the marketplace would pay. So number one is succession, and that is a secular trend that'll continue. And number two is scaling. Look, scaling matters. And as you scale, you're going to change the business. And Fred, we're not even there yet. What's really interesting, and getting back to the consolidation, the academic curve, for some firms, we're leaving the scale phase and we're entering the focus phase. And it's going to be the most interesting phase. It's where Prudential and MassMutual and all the other regulators decided no mas. And frankly, that's what I would expect over the next 5 years here. Can these firms that were successful in scaling then take all these people, and this gets back to your question about, are these firms kind of happy with where they are together, the buyers and sellers? Well, we don't know yet, because the real test is, can you take all of these firms you bought and turn it into a business? Can you back office? Can you engage the participant? Because if not, Fred, what was the point?
What percentage of the sellers are leaving once their earnout is done? I know that Daniel Bryant, he left the day after. Jim O'Shaughnessy, he's still there from Sheridan Road. Do you have a sense of how many or what percent? Because that's really
it makes sense or it doesn't. I was there for the money and now I'm gone. Daniel is just very entrepreneurial and wanted to do some other things. But what are you seeing on that side?
Fred, that story is the rest of that story is it's being written right now, right? Because you have the first major wave starting to come off of earnout and what
Right.
happened. But I have a couple things I want to share with you here. The first is don't undervalue the equity that came with part of that deal, right? You get hub equity, NFP equity, you get one digital equity. That has become in many ways the most valuable piece of it. And that equity grows because these folks are part of a bigger team.
Okay.
So they want to continue that, right? Here's the other part, and this is, I think, much more powerful. I ask this question all the time from management teams, from folks who were producers and got acquired and now they're running these shops. But here's what I say, and here's what I hear, and this has been very consistent. They don't want to let the people down who they've brought on the last 3 years. They do feel like they're part of a family. They've recruited their friends. They've promised, they've gotten good deals and the earnout might be done, but these folks are into it and they're not walking away because they're into it. If anything, I kind of scratch my head and say, why are you working so hard? I know how much money you have. And that's the way they wired. They don't know anything else.
Fred, the other thing is that, many of these people have made the decision, Jim O'Shaughnessy, many others, to do something different within the organization. So, Corby Dahl is able to recruit. Jim O'Shaughnessy is able to be more 30,000 feet. And no doubt that many of these advisors who are now in their 60s, have done it for a long time, don't necessarily want to go through the grind of day-to-day client servicing, Fred. But what they want to do is keep the machine going. They want to provide other services. So, to me, that was the whole point in the beginning is go to this firm, monetize your business, allowing yourself, your staff, your clients, but also when the time comes to do something else, you're in a firm that'll allow you to do that. So many have gotten there. Now, Fred, there is going to be some breakage, right? If you got a $10 million check and another $3 million in an earnout, and you're now 64, some of those folks are going to retire. But it's going to be in line with, and I would say Peter's point is spot on. There's a lot of reasons to stay.
Yeah, I think roll-ups are hard, right? Who was the firm that financed the NFP roll-up, the original one? I forget the guy who came very successful, said that'll be the last roll-up I ever do. So, and I've heard other people say the first roll-up that's successful the next roll-up will be the first one. So
yeah.
Why is that? Why do you think it's happening? And what are the difficulties there with a roll-up?
Well, Fred, I think, as Peter said, the story remains to be written. We are now in the phase that, in my opinion, is going to cull the herd, because it's one thing buying 40 firms and putting them in place and throwing some tools and services in there. It's another thing having to back office things because fees are being compressed, and you need to be more efficient. You need to have your producers out there producing. And number two is engaging the participant and other things to drive revenue. So Fred, the next 5 years will not be pretty, to be frank with you. And I think it's why Mercer's Mercer, because 10 other firms failed. Empower is Empower because 10 other firms failed. And frankly, we'll see. I think you can, and Fred, you were the one years ago that said the question's not who's leaving, who's not going to be here. The question is which record keepers will remain. And I think you can start asking the same question. So the next for aggregators. And I'm not saying any of them will go away, but private equity has a funny way of determining value. And they might decide they're better off selling one of those divisions to another group versus continuing to recap. So a lot of things can happen, but execution, Fred, is going to be what we're going to be looking at in the next 5 years with these firms, not recruiting of new businesses.
Those who did stack and were highly levered, they have been flushed out of the M&A world, shut down or stopped, right? So the pure stacking is proven to obviously not be the right way to go. But yes, there's different levels of integration and success that's happened. But here's the proof, right? Like topical proof. You have Hub, right? Hub has done a lot of acquisitions. Hub is trying to integrate, and they're doing it, right? It's tough. It's a big organization. But when you have a firm just 3 weeks ago, like Leonard Green, right? Easily one of the most sophisticated institutional investors in the world, bar none, right? when they will take a minority stake with no rights whatsoever, and they'll put, large sums of money into this to be the third private equity minority partner. You don't bet against those folks. They obviously feel, the integration's not perfect, but there's still so much there and so much potential. And Hub is just one of the examples of how this can work and be incredibly dynamic.
Hey, Fred, one more thing, sorry, is something to look for, right? Leading indicator. So I would say when you start to see change in leadership at the aggregator level, and that leadership is not of the industry, but people who are builders, you'll know the next phase is in full force and effect. And I think that's going to happen, meaning these wonderful practitioner, producer, business developers who sold their businesses and are incredible, but Fred, are they world-class builders? Right. And so the answer to that, most are probably not. And if you're a private equity firm investing a lot of money and you're a couple, 3 years in, you're going to start to think, well, how do we get this to the next level? Now that we're done with the scale phase, what do we do in the focus phase? So that'll be an interesting thing to look for.
So that is what I want to focus on now, is the future. What does that look like? I know we talk about convergence. I'm a, full believer in convergence and dedicated to it, the convergence of wealth, retirement, and benefits at work. It's too obvious, right? It's got to happen in some way. What does the future look like? And really, because we talked to two audiences, the reason I left Napa is Napa Net, which I wrote and founded, it was an echo chamber. There was only so much you could talk about if all you were talking about was 401k and, ESG and Secure 2.0. But when you expanded to wealth and benefits and all of it, it's like it just grows on that. Yeah. So what does the future look like, and why most wealth advisors are selling RIA firms, but we're starting to see that change? What's the advantages or the disadvantages of a wealth advisor joining an RPA firm? Because they're starting to look at that market very heavily. They have been for the last few years.
We'll do an old-fashioned boxing tail of the tape, right? Put the two fighters, here's their reach, here's their records. So on the wealth aggregator side, right? And I've gotten to know these firms. I've gotten to know these firms quite well the last couple of years. They are sophisticated, they are efficient, a well-oiled tech stack. I have found them to be very disciplined integrators. Yep. Not a lot of debate about whether you're doing this or that. Like it's happening, right? And they get the efficiencies from that. But what they don't have, even though some have marketing, digital marketing, call-out programs, you name it, they don't have the ability to a huge catalyst for growth beyond giving you back some capacity from the efficiencies that you got from integrating, and then whatever they can sprinkle in terms of their business development, right? But minor. Now, tail of the tape other side, RPAs, excellent retirement operators. That's the background, right? Emerging tech stack and starting to integrate, still not getting it, but smart people, and they'll get it eventually, right? A little bit spotty in the integration. They still don't like to ruffle feathers too much, but the potential is insane. Like when you consider it in ways that you can't even imagine. Yeah, there's a retirement and wealth bridge, but what about this bridge that exists between some of these firms that have huge specialty line insurance businesses where they insure someone's race car and yacht and airplane and any of the toy? Listen, those are really wealthy people that they have relationships with, tens of thousands of them, that they can be walk-in a wealth advisor. Now, who wouldn't want to lead like that?
Right.
And that's just one way. That's not even engaging all the millions of retirement participants or ticking the C-suite of all the retirement plans. So they have huge potential for growth and to help.
Yeah, I know One Digital just passed the 1 million participant mark, and they're not the only one, right? That's already been happening. Mark Bruno says that, from wealth management, he said, when you buy an RIA firm, you get what you get, and there's revenue and opportunity. When you buy an RPA firm, you get their revenue and opportunities, but then there's all those participants in there.
Yeah, and Fred, I don't know if, I was thinking about like the Colorado River, right? You have the water issue. And I'm not sure if all the work that, CapTrust H2 Hub does will reduce the spigot, the water coming through the IRA rollovers, but it certainly is not going to help. And having access to in-plan individuals and saying, well, the work site's where it happens. It might be one of the last places in the US where people actually trust someone. They don't trust other institutions. They have access over time. Fred, it's going to have an impact. So it's not just, it's an advantage to these RAAs. The question becomes, will there be enough of a reduction in the flow down the river? And so as all these RAs are kind of competing and building downriver and the water's, what happens when the water shuts off? So I would just, our thing to the RAs is, hey guys, there's really a fork in the road. And one, the other one is a road you've never taken, but it might be the best road. And that's a retirement business. To Peter's point, that does all the other things, but gives you growth capital.
Right. And so how do you see Wise Rhino changing? You've been around since, I think it was February of 2018. Is that about it?
It was, yeah. Well, yeah, mid-March actually, but right there, yeah.
And so you've been around, you're 5 years now. What's the next 5 years look like for the Wise Rhino Group?
Well, I'll let Peter provide most of that answer, but Fred, maybe Peter talk about the mix of our business. And we started out, the first 3 years was retirement. This year, it'll be of, 4 verticals, I don't know, maybe third in terms of deal activity. So Peter, maybe talk about that.
So, yeah, we certainly started out with a core of retirement advisors that maybe had a incremental wealth business, or maybe the wealth business becomes something significant. We have branched out even this past year into a significant presence in the TPA world, because it's a tangential business for sure with retirement. We do more and more wealth only as we take advantage of the great relationships we have with some of those RPA buyers, as well as the traditional wealth aggregators, right? So we kind of have the best of both worlds to introduce to folks who are just doing wealth. We've done wealth tech, actuarial, all kinds of different retirement related. But Fred, the next 5 years, it's a great question. The work we do, we've had great success, and we're very thankful for that. But it's a bit of a mission at this point, right? Like people, great business owners who have worked their life to build something special, have a strong desire to monetize that and to make sure that they're set up and their families are set up and their teams are set up for success. And there are still hundreds of thousands of firms out there that don't have a guide and don't have an answer for succession. So, we want to continue to work and help people, because I've said this, and not to get if I start crying, then please, we're going to have to re-record.
We're going to have to cut you off there, Peter, if you start crying.
This is a rare occasion where we're involved in something where everyone can win. We get a small piece of what happens. The buyers are thrilled to have the talent and the practice, and the sellers are thrilled that they have a future and have monetized their life work. Like, how often can you be involved in triple wins? So
yeah, and by the way, Fred and Peter, most 2/3 of our clients you never hear about because they're not transactions, Fred. They are helping a firm decide not to sell. And by the way, we do a lot of that because we don't believe we're going to tell them. Helping a firm get better, become more resilient, buy. So that'll continue.
So last question, when you work with mostly when you work with a wealth advisor and they choose to join an RPA firm versus an RAA, I'm sure they have, their choices and on that. When they do choose that RPA firm, why are they making that decision?
Because their wealth business, there are 1,000 different shades of wealth management. Some of them are more active than others and more trading active and perhaps more stock selection. But there are many wealth businesses that are very straightforward, RAA model based, and they fit very nicely without much accommodation or change into what the RPAs have in their level of sophistication right now. And that's the majority, by the way, right? That's most wealth practices are model driven, right? But it's the overwhelming opportunity and catalyst for growth. So they can accommodate the wealth business and do so with little disruption. They have an amazing support mechanism for their retirement business, if there happens to be one there, and they have those catalysts. To me, that's the difference.
Last words, Mr. Rhino? That's you, Dick.
You're Mr. Rhino.
Yeah, I got confused by
I'm
Mr.
Junior.
Rhino.
I'm Junior Rhino.
No,
Fred,
this is Rhino.
Yeah,
Come on.
exactly. I'll tell you, Fred, it's been a thrill, for me, and it's the thing I thought of, which is there's, getting, and this is going to be hokey, but I'll tell you, Peter and I here, we always wonder if we charge enough because our clients tell us we don't, but they tell us that we help change their lives. So I mean, it happens all the time, and I'm just really happy for the people that are in this industry that are having the success they have, and to be part of it's been amazing.
Right. So just to clarify, you're changing for the better, not for the worse, right?
Well, I'm trying to, but that's, you know me well enough, Fred, to know what that's all about.
There you go. Well, thank you very much for your time. Congratulations on your success, both of you. It sounds like a good partnership there and for your firm. And
Thanks, Fred.
Thanks for joining me today on 401k Real Chat. On that, I've been speaking with Dick Darian and Peter Campagna from the Wise Rhino Group, the leading M&A RPA advisory firm. Thanks, guys, for joining.
Thanks, Fred.
Thanks, Fred.
This is your time to respond. Yes, thanks for this watching this episode of 401k Real Chat. Let me know who else you would like to hear from, and I will invite them to get real.